Welcome to What's the Value? Thank you for joining me today. I'm pleased to provide an analysis of the latest U.S. Consumer Price Index (CPI) report released for October. Understanding these figures is crucial as they offer valuable insights into the current economic landscape and help us anticipate future trends. Today I will compare the recent CPI data with previous reports and analyze the potential impacts these numbers may have on our economy, businesses, and everyday lives. Let's begin by examining the key figures from the latest CPI report. Headline CPI month-over-month increased by 0.2%, remaining unchanged from the previous month. Year-over-year rose to 2.6%, up from 2.4% in the previous report. Core CPI month-over-month increased by 0.3%, remaining unchanged. Year-over-year steady at 3.3%, unchanged from the previous month. Comparing these figures to previous data, we observe that while the monthly changes in both headline and core CPI have remained stable, there is a noticeable uptick in the annualized headline CPI, increasing from 2.4% to 2.6%. This acceleration suggests that over the past year, the overall price level has risen at a slightly faster pace than before. In contrast, the core CPI, which excludes volatile food and energy prices, has remained constant on both a monthly and yearly basis, indicating persistent underlying inflation pressures. Time for mentioning about analysis of potential impacts as first, monetary policy adjustments. The Federal Reserve closely monitors CPI data to make informed decisions about monetary policy. The uptick in headline CPI, although modest, may prompt the Fed to consider tightening measures to prevent inflation from accelerating further. This could involve raising interest rates, which would have wide-ranging effects on borrowing costs for consumers and businesses alike. Financial markets and investments. Stable month-over-month CPI figures might initially suggest a calm in financial markets. However, the year-over-year increase in headline inflation could lead to increased volatility as investors anticipate potential Fed interventions. Higher interest rates generally lead to higher yields on savings and bonds, which might attract investment away from the stock market, potentially causing fluctuations in equity prices. Consumer spending and cost of living. An annual headline CPI rise to 2.6% indicates that consumers are experiencing higher prices over the year. While this increase is relatively moderate, it can impact disposable income and consumer confidence. Households may become more cautious with their spending, prioritizing essential goods and services over discretionary purchases, which could slow economic growth if widespread. Wage negotiations and employment. Persistent core inflation at 3.3% suggests that the cost of living continues to rise, putting pressure on workers to seek higher wages to maintain their purchasing power. This could lead to more robust wage negotiations and potentially higher labor costs for employers. While higher wages can boost consumer spending, they may also squeeze profit margins for businesses, leading to adjustments in hiring or investment strategies. Housing market dynamics. Higher inflation and the possibility of rising interest rates can significantly impact the housing market. Increased borrowing costs may dampen demand for mortgages, slowing down home sales and potentially leading to a cooling of housing prices. Homeowners looking to refinance may also face higher rates, affecting their financial planning and spending capacity. Business investment and expansion. For businesses, higher inflation can lead to increased operational costs, from raw materials to labor. Companies may become more cautious in their investment and expansion plans, opting to delay or scale back projects in response to uncertain economic conditions. This cautious approach can affect overall economic growth and innovation in the long term. Strengthening or weakening of the U.S. dollar. Inflation influences currency strength. An uptick in inflation might lead to expectations of higher interest rates, potentially strengthening the U.S. dollar as investors seek higher returns. Conversely, if inflation persists beyond expectations, it could erode purchasing power and weaken the dollar, impacting international trade and investment. Commodity prices. Inflationary pressures often drive up the prices of commodities such as oil, gold, and other raw materials. Higher commodity prices can increase production costs across various industries, contributing to the overall inflationary environment and affecting profitability and pricing strategies for businesses. Bond market adjustments. Rising inflation typically leads to higher bond yields, as investors demand greater returns to compensate for the eroding value of fixed income investments. This can result in declining bond prices and impact portfolios that rely heavily on fixed income securities. Future economic growth projections. Persistent inflation can dampen economic growth by reducing consumer spending and increasing business costs. Economists may adjust their GDP growth forecast downward in response to sustained inflationary pressures, influencing policy decisions and investment strategies. In summary, the latest CPI report reveals a nuanced economic picture. While month-over-month figures remain stable, the year-over-year increase in headline inflation underscores ongoing inflationary pressures. These developments have far-reaching implications, from monetary policy adjustments and financial market volatility to changes in consumer behavior and business strategies. As we navigate these economic conditions, it is essential to stay informed and adaptable. Whether you're a policymaker, business leader, investor, or consumer, understanding the dynamics of inflation and its impacts can help you make informed decisions that align with your financial goals and stability. Thank you for your attention. I look forward to addressing any questions you may have.